Okay, guys. Good day, good day. Thank you. Welcome again sa ating course. So this is a continuation of our discussion on Chapter 2, the separate and consolidated financial statements as of the date of acquisition. This is for the course entitled Business Combination. Right. Yes. Thank you, guys. Thank you. Right. Okay, so let's continue. Previously, we have tackled the what you call this, the control premium and the control discount on the um what you call this, as of the date of acquisition, right? Right. Yeah. So moving forward, ayan. So ang ating next topic would be the nature and presentation of non-controlling interest. Okay? So, ownership interest in a subsidiary other than the parent are referred to as the non-controlling interest. So, non-controlling interest is the equity in a subsidiary not attributable, not attributable directly or indirectly to a parent. Okay? Non-controlling interest is to be identified as and presented within the equity. So, part pa rin siya ng ating uh, equity portion, right? Right. So separately from the parent stockholders' equity, it is regarded as an equity contributor to the group rather than a liability. Okay. So this is because the non-controlling interest does not meet the definition of a liability as contained in the framework, because the group has no present obligation to provide economic outflows to the NCI. Because this non-controlling interest holds ownership, still ownership, though uh, these are non-controlling interest, di ba? Kapag uh, ownership kasi, di ba, it is not readily or immediately uh, demandable or payable, right? Right? Then yung sa economic outflow, it is not um yun, hindi siya mag-qualify nga as a liability as defined sa ating framework. Gets? Gets. So the NCI receives a share of consolidated equity and is therefore a participant in the residual equity of the group. Okay? So the fair value option. So option 1, full value approach. Permitted, ayan, yun, yung full goodwill approach. Permitted for non-controlling interest brings revised PFRS 3 closer to the entity theory. So the entity theory upholds consistency in accounting measurements of the assets and liabilities of the combined entity, regardless of who the stakeholders are. Okay, so the entity theory does not support a fragmented valuation as embodied in the parent theory. Excuse me po. Ayan, which focuses on information primarily for the shareholders of the parent company. Okay? So gets yan? Gets? Right. So as I have mentioned earlier, you can actually read more on this part sa inyong book, page 131. Okay, chapter 2. Right? Right. So, however, the second alternative, yung ating um, proportional or partial goodwill approach, right? The second alternative permitted by PFRS 3 with respect to recognizing non-controlling interest as proportion of fair value. Yan, yung second ano natin. theory, I mean approach. So option 2, partial goodwill approach or proportional basis of identifiable, etc. Right? So although the entity theory is not without its critics, it provides a conceptual basis to recognize, measure, and uh, present non-controlling interest in a consistent framework. So parehas. Yan. So what one question? Can non-controlling interest be a debit balance? Hmm, let's see. So non-controlling interest shares of losses in a subsidiary may exceed their share of the subsidiaries share capital, retained earnings, and other equity items. So PFRS 10 requires the non-controlling interest to have a deficit balance under such circumstances. So the answer is yes, non-controlling interest can have a debit balance. Right, right? Alright. Kasi part pa rin siya ng equity. Okay? So, kapag yung ating retained earnings is actually a deficit, so the non-controlling interest will also form part dun sa distribution ng ating deficit. Okay? So, other applications of the entity theory to non-controlling interest. So, the entity theory views all shareholders of the combined entity as equity holders. So PFRS 10 states that non-controlling interest shall be presented in the consolidated statements of financial position within equity separate from the equity of the owners of the parents. Okay, so profit or loss and each component of other comprehensive income are attributed to the owners of the parent and to the non-controlling interest. So total comprehensive income is attributed to the owners of the parent and to the non-controlling interest, even if this results in the non-controlling interest having a deficit balance. Okay, so this is under PFRS 10. Right, right? Right. So under the entity theory, the depreciation and amortization of fair value differentials that affect the majority interest also apply to the non-controlling interest. So meron pa rin siyang share sa depreciation and amortization ng fair value differentials. Okay? Right, right? Right. So let's move to the consolidated financial statements under PFRS 10. Saan na ba tayo? Ayan, tama. So the concept that drives all consolidation procedures is that the consolidated financial statement should show only the results of transactions with outsiders. The effects of the accounts of transactions between the parent company and its subsidiaries or between subsidiaries should also should always be eliminated. Okay? So na so the effects on the accounts of transactions between the parent company and its subsidiaries or between subsidiaries should always be eliminated. Okay? So yung effect daw ng accounts. Okay, we will have more on that. Okay, as we move on to the scores. Right, right? Alright, so the statements prepared for a parent company and its subsidiaries are called consolidated financial statements. They include the full complement of statements normally prepared for a separate entity and represent essentially the sum of the assets, liabilities, revenues, and expenses of the affiliates after eliminating the effects of any transaction among the affiliated companies. Okay, so we will have more on that as we move further sa ating uh, chapter. Right. Right. So consolidation procedures using the acquisition method. So this is the general approach. So although two sets of accounts have to be prepared, the investors separate financial statements and consolidated or group financial statements. So yun yung dalawang sets. Only one set of books or ledgers has to be kept by the legal entity. So there are no, excuse me po, there are no ledgers kept for the group entity. Instead, consolidation worksheets are prepared at the end of each reporting period, which combine the separate financial statements of a parent and its subsidiaries and include consolidation, elimination entries, and adjustments to remove the effects of intercompany transactions. Okay? So, consolidated statements are prepared from the point of view of the shareholders of the parent company. The following items are to be noted. One, consolidation adds the elements on the financial statements of subsidiaries and structured entities to those of the parent. So, if I can remember it clearly, okay, we have um, some clients before when I was in an auditing firm. We compiled the financial statements of a group, okay, group of companies. So I handled one company, one subsidiary of that group. So I prepared the complete set of financial statements. Then after that, we were required to pass it forward dun sa um, parent company. Okay? I mean kung sino may hawak ng parent company and he or she will do the consolidation. So on the books of the subsidiaries, if I remember it right, sa actual practice, there's no um, uh, actual movement. I mean, when it comes, I mean, there will be no effect, okay, dun sa magiging consolidation when it comes to the set of financial statements no subsidiary unless there are transaction adjustments to be carried forward by the subsidiaries like inter-entity transactions or um, expense or revenue adjustments ng mga ganon. Okay, so I think we will also have some examples on that as we go on through this chapter. Okay? Yeah. So, um, another item to be noted would be on the balance sheet of the, I mean, on the balance sheet or the statement of financial position, there will be no investment account for the controlled subsidiaries and structured entities. Okay? Instead, the assets and liabilities of the controlled entities will be added to those of the parent to show the economic resources of the entity. Ito yung sinasabi ko kanina. Fino-forward namin um, yung financial reports ng subsidiary to the one handling the books of the parent company. Okay? So on the statement of comprehensive income, the revenues and expenses will be the totals for each item for the parent plus the controlled entities. This is for the consolidated statements. Okay, so the effects of any and all intercompany transactions will be eliminated to avoid double counting. Okay, so dapat once lang ma-recognize yung um, transactions. Okay, right. Yan. Then, ayun, yun. Okay, to avoid double counting. So, yun yung mga items to be noted when doing the consolidated statements. Okay. So, in this chapter and in the succeeding chapters, um, the flow of ay, the follow ba? Tama ba to? Wait lang guys ah. Medyo nalito kasi ako sa okay. So in this chapter, in the succeeding chapters, the follow the chain sige basahin muna natin. The follow the chain of steps. Baka they follow to. Anyway, they follow the chain of steps that we may describe it as the keywords are mere. Parang name ko lang Sir Armir. Joke lang. Ayan. So, Armir is a mnemonic that stands for the four steps in a typical consolidation procedure. So, Armir, the steps to consolidation at the end of the uh, first year following the acquisition. So, take note of that. Ayan. And of the second year or later years following the acquisition in as discussed in chapter 3 and 3, 4, and 5. So, RMIR stands for RM for reliability measurement. E is for eliminate. A is to amortize, and R is to recognize. So, first step would be the reliability measurement. Okay, then eliminate, amortize, and recognize. Right. Yan. Biu. Sabi ng baby ko. Ayan. Matalastas. So, the reliable or reliability measurement step requires to A. Calculate costs and fair value adjustments. Okay? So, this is tackled in our chapter 1. Then, B. Allocate the fair value adjustment through under over valuation of assets and liabilities. This step involves determination of fair value of subsidiary, okay, as we have done in the prior slides, and over or under valuation of identifiable assets and liabilities in the schedule of determination and allocation of excess. Okay, so we have done this a few times, okay, in these subsequent chapters. So I think I hope that you will have no trouble on this. Okay, so in theory, acquisition method of accounting combines the carrying value of the parent with the fair values of the purchase subsidiaries. So specifically, the fair value adjustment is first allocated to the various identifiable assets and liabilities of the acquiree to the full extent of their fair value increments or decrements. Any excess of the fair value adjustment after the allocation process is allocated to goodwill. So we have done this a few times before. Right? Right. Then, next step would be the eliminate step requires to A, identify and eliminate all intercompany transactions and balances. Okay? So we will have more on this. Letter B, calculate and eliminate any unrealized profit or loss relating to the company sale of inventory. So this is in the chapter 4. And fixed assets in chapter 5 in the current period. So calculate and recognize the profit or loss in the current year on the sale of inventory and fixed assets in previous periods. So in this chapter, the reliability measurement and eliminate step will be introduced while in the succeeding chapters, we extend the uh, RMER concepts further. Okay, so next is to amortize. So in this step, we amortize the we amortize the fair value adjustment allocated various identifiable assets and liabilities. For example, the over and under valuation relating to those assets and liabilities in the current and previous periods. Another one, write off any impairment of goodwill and other intangible assets and indeterminate useful lives in the current and previous periods. Find the balance of the allocated fair value adjustments remaining unamortized and unimpaired at the end of the current period. The last step would be recognize non-controlling interest. Uh, okay, so step one is recognize the non-controlling interest shares of earnings, calculate NCI for balance sheet purposes, calculate consolidated retained earnings. So that is the uh, Armir steps. Okay? Ayan. So, saan na tayo? Armir. Okay? Armir. Armir, baby. Iskang. Natalastas lang. For a while, guys. Ayan. So, kamusta pala kayo mga guys? Ayan. So, the steps mentioned above were already embedded in each illustrations to be discussed. Okay? So, under direct approach, so we have two approaches. So, the direct approach, there are two general approaches to preparing consolidated financial statements, the direct approach and the uh, worksheet approach. So the direct approach prepares the consolidated financial statements or consolidated statements by setting up the income statement or statement of comprehensive income and ano to? Ayan. And excuse me. And computing each consolidated balance directly. So each asset, liability, revenue, expense is separately calculated and entered into the consolidated statement. So the direct approach works from the separate entity financial statements of the parent and subsidiary. Okay? Ayan. So, sabi dito, sa direct approach, um, sineset up yung uh, and computing each consolidated balance is direct. Okay. And so, parang pinag-a-add na lang yung mga totals or the accounts of the parent and subsidiary. So, we will have the exercise and format on this. Okay. So another approach is the work paper approach. So the work paper approach, the alternative method is the work paper approach. The worksheet or um, spreadsheet approach uses a multi-columnar worksheet to enter the trial balances of the parents and each subsidiary. Then elimination and adjustments are entered into the worksheet and the accounts are uh, cross-added to determine the consolidated trial balance. Okay, so we will see more on this to better understand. Right, right? Uh, so, which approach to use? So, the direct approach is spontaneously appealing because we are working directly with the statements and can see clearly what is happening to the consolidated statements as elimination and adjustments are posted. When the statements are to be consolidated are fairly simple, it is quite feasible to compile the consolidated statements by the direct method. Okay, so sabi kapag um, fairly simple yung statements ng ating parent and subsidiary. So we can use the direct approach. Okay, so ayun. So the work paper approach is less spontaneous. So in this chapter, we will illustrate both approaches. The direct method will be presented in the first and the worksheet approach second. Both approaches yield the same result. It doesn't matter which approach tuloy, cockroach, coach, roach. It doesn't matter which approach is used. What is important is the result. So, not the method used to drive the result. Tama nga naman. Right, right, right? So, pwedeng long cut, pwedeng shortcut, pwedeng both cut. Basta parehas yung gupit. Okay? Yeah. So, consolidating parent and subsidiary. So, simple illustration, consolidated balance sheet at the date of acquisition. So, the condensed balance sheet of a parent before setting up its subsidiary is shown below. So, this is the balance sheet of the parent. So, ang kanyang asset is cash, 100,000. Then, common stock is 50,000 and retained earnings of 50,000. So, the total liabilities and equity is 100,000. Right, right? Yan. Ang simple ng balance sheet niya, no? Parang formally. Ay, mali. Just lang. Ayan. So, assume that the parent founded a subsidiary by investment of 10,000. The separate balance sheet for each company, excuse me, are provided below. Notice that we introduce an investment in subsidiary account for 100 I mean 10,000 in the parent's balance sheet and a counterbalancing share capital account of for 10,000 in the subsidiaries balance sheet for the parents point of view. So no new owner's equity was created by the formation of subsidiary. All that happened is that one asset, so yung cash, was decreased while another account, yung investment naman, ay nag-increase by the same amount. It is its total equity continued to be 100,000, which yeah, it does make sense. Okay? So sa asset niya, meron tayong investment in subsidiary. Right, right? Right. So dun sa subsidiary balance sheet naman, meron siyang increase sa cash, meron din siyang increase sa stock holdings. Okay? So both the investment in subsidiary account of 10,000 in the parent's balance sheet and the common stock account of 10,000 in the subsidiary's balance sheet are eliminated. So from the consolidated perspective, one asset, which is cash, went up by 10,000 while another asset, which is investment in subsidiary, went down by the same amount. The subsidiary common stock is not added to parents' common stock since it is ahead reflected in the parents' total equity of 10,000. To consolidate the subsidiary immediately after its creation with the parent, it should get back the original balance of the parent, which is yung cash natin is 100,000, yung common stocks natin and retained earnings will still be the same. So that is for the uh, consolidated, okay, consolidated statements. Okay, that is immediately after the immediate, excuse me po, ayan, immediately after the acquisition. Okay? So sa ating work papers approach naman, ito yung mm, medyo mas maganda yung presentation. Okay? So the entries to eliminate the investment in subsidiary account in the parents book and the share capital in the subsidiaries book and parents consolidation worksheet are provided below. So debit common stocks, credit investment in subsidiary. Okay? So ito yung trial balance natin. Sa parent, we have yung 90,000, then yung investment in subsidiary na 10,000. Okay? Ayan. So dun sa subsidiary natin, we have a debit of cash amounting to 10,000, credit common stock of 10,000. The adjustment, okay, debit sa investment in subsidiary to eliminate the investment account, then debit sa common stock. Okay? So our consolidated values would be cash of 100,000, common stock of 50,000, and retained earnings amounting to 50,000. Okay? So the consolidated balance sheet under the work paper approach will be identical to the balance sheet derived under the direct approach. Okay? Direct approach. So that is our simple application. So we have here a comprehensive illustration. We will discuss this more dun sa ating next recording para we'll have a more time. So please digest yung ang ating discussion. Then right after you watch this presentation, we will please immediately refer to the next presentation, which will be this, which I will be discussing more illustrations on this. Okay, so if you have questions, clarifications, reactions, please don't hesitate to message me through our LMS group chat or our Facebook Messenger group chat. Okay, and again, see you on our next recordings. Have a good day and goodbye.